Morning, ladies and gents. My name is Simon Brown. I'm hosting this webcast today with 10x Investments. It's not going to be me giving the answers. I'll be getting questions from the experts. We're looking at building blocks to a lasting living annuity. One of the key things, and I've spoken about this often on shows and TVs and webcasts, is sort of our entire focus around saving and investing is getting to retirement and having sufficient money for retirement. And the how much is enough money, it's a bit of how long is a piece of string, but nonetheless, that's the focus. Then, of course, we get to retirement, and hopefully we've got a big pile of money which is now available to us for our retirement. And that then really starts the incredibly hard questions. And they're not truthfully hard to the experts like we'll have on our panel, but they're hard to you and I, who the difference between living and guaranteed and drawdown rates and offshore versus local and all of this. And these are, I don't want to say they're not life defining, and certainly we can make tweaks along the way. It's not like we make a decision and that's now going to be it forever and a day. But there are a lot of questions that we have at that point in time. And unfortunately, oftentimes the folks that we are engaging with, and we'll exclude present company from that, of course, more interested in the fees than actually in that process. So today we've got two from 10x Investments. Kelin Pottier, he's a solution strategist at 10x Investments, and Brett Mackay, investment consultant at 10x Investments. Gentlemen, welcome and thank you to both of you. As I said in the intro there, that the plan today really is to try and help with those questions which come up sort of when we get into our retirement, or for some folks who are in retirement and want to look back at what they've done. Ladies and gents on the webcast, if you've got questions, drop them into the Q&A. If it's something I'm going to come to later in the presentation, we'll come to it at that point. Otherwise, there is time at the end. We can certainly take questions then. What we're not going to be doing today is personal specific, particularly around tax, but particularly around individuals' cases. If you need that sort, you can obviously get hold of 10x. They can obviously help you in that regard. Kelin and Brett, I really appreciate you're going to be our masterminds today and guide us through. And Kelin, let's start with you with the classic question is always, so if we've come out of a Reg 28, we now have to buy an annuity with 2/3 of that money. And the question then is, well, hang on, living versus guaranteed. What are the differences, some of the sort of high level pros and cons? Because I think that's the first thing that sort of people stumble into and get stuck.
Sure. Thanks again for having us on this morning, Simon. I think when you get to retirement, there's really two options facing investors. The first is a guaranteed annuity. A guaranteed annuity is an insurance type product where you hand over your retirement savings that you've earned over your life, and in return, an insurer guarantees you to pay you a fixed amount of income every month until you pass away, effectively. A living annuity, on the other hand, is more of an investment style product where you get to continue investing your hard-earned savings, you get to continue growing that money tax-free, and you get to draw down an income from the returns of your investments. And so while both products are seeking to give you an income in retirement, the features and benefits are quite different. And so it's important to just navigate the pros and cons of each, really.
I take your point, and and I think it's a key point you use. The guaranteed is kind of like it's an insurance product, and you can have one with your partner so that it'll void on the passing of the second person, as I recall, which certainly is a useful and a benefit. There is, of course, then no legacy to your heirs. You've essentially bought a retirement product. That living one gives us a lot more flexibility in terms of drawdowns, although there are rules around that, but also flexibility in terms of where we're going to invest and how we're going to invest. And that raises a key point, which kind of ties to what I said in the intro. We sort of invest and we kind of think we're investing until the age of 60, maybe 65, depending on our retirement. But truthfully, we are still investing in retirement if we've gone with the living annuity.
Absolutely. So I think that's where the distinction is critical between a guaranteed annuity and a living annuity. While it's a guaranteed annuity, the insurer takes on any risk of you outliving your investment, so they guarantee to pay you income until your death. You're not exposed to any market risk, so it doesn't matter what markets do. It's of no concern to you because the insurer is taking all that risk. When you're investing in a living annuity, you're effectively self-insuring. So your idea is to put your money to work in a way that can generate investment returns such that you can live off of the investment returns without necessarily needing to dip into the capital. And so that does introduce some risk. So there is a risk that you outlive your capital because you are not investing appropriately, you're not drawing down a sustainable rate, or you're not paying attention to the impact fees are having on your investments. But we've seen time and time again, from our research, more than 75% of retirees actually choose to go with the living annuity because of all the flexibility benefits. So, for example, you get to have flexibility over your income. If next year you need more income than you needed this year, you can adjust your income. If the year after you need less, you can adjust that. If you would like to have control over your investments, would you like to invest in equities? Would you like to be more conservative in bonds? Would you like to invest offshore to be able to generate more hard currency income in retirement? That's an option that's afforded to you by a living annuity. And like you said, the big difference is with the living annuity and a guaranteed annuity from an estate perspective is that with a guaranteed annuity, when it's done, it's done. However, with the living annuity, if you pass away and there's still capital left in your living annuity, you get to bequeath that to your beneficiaries who you nominate. And so not only is there a big legacy element, which investors absolutely love, especially those who've been planning and saving diligently throughout their working careers, but investors also find it particularly helpful because it's a very effective estate planning tool, as there's no estate duty levied on the proceeds from your living annuity on your death.
And I can... Sorry,
Brett. Sorry, just to add to that as well, with a living annuity, with a guaranteed annuity, you can always, from a guaranteed annuity, once you go into a guaranteed, you are locked in there. With a living annuity, you can always transfer from a living annuity to a guaranteed annuity later down the line. So it's very important to keep that flexibility option open, just because down the line you might come into a situation where you would like to transfer your living annuity to a guaranteed annuity, and you can do that. Whereas if you start in a guaranteed annuity, that is essentially the end of the road.
I take your point, and that was my follow-up question was going to be, could I do a combination of living and guaranteed? And I know a lot of folks will say, kind of like I use my guaranteed perhaps for medical and food, so that I know I'm going to eat and I know I can go to a doctor, and then the rest, which is the fun stuff, the wine and the holidays, I suppose, I use for the living. And is there also a benefit perhaps to multiple living? To your point, Brett, at some point I might want to convert some. So instead of putting everything into one living annuity, maybe 3 or 4 or 2, I don't know what the magic number is, and then it gives me optionality as time goes.
Correct, yeah. So you can have more than one living annuity. It does help with flexibility. For example, you could have 2 different living annuities with different drawdown rates, different asset allocation, and you can stagger them into the guaranteed annuities as time goes on. So it does help with the flexibility side of things.
One of the risks of a guaranteed annuity is inflation. You can get them where they pay you an amount and it doesn't increase, in which case inflation is going to overtake you. The other is that you can take it with annual increases of a number, and almost any number you pick at the point of retirement at some point is probably going to be below what inflation is, because as you've seen over the last 3 or 4 years post-pandemic, inflation can rear its head. That is a proper risk and a consideration, I think, which folks need to take into account if taking a guaranteed annuity, because the terms and conditions are set on day one and they're in place until day end.
That's exactly right. And I think that's why many investors have sort of woken up to that fact and have seen the benefits in a living annuity. I mean, very simply, how is an insurer providing you that guaranteed income? The insurer is taking your pot of money and they are investing in long-term government bonds, and they're effectively using those bonds to pay you your income as you go through life. And any additional income beyond that is really pooling benefits. That's you benefiting from anyone else who's died before the actuaries estimated they would die, and some of those benefits get shared with other policy members. But we know historically, looking back at more than 120 years of data, bonds and cash or low risk investments have really struggled to keep pace with inflation. Typically, only delivering about 1 to 2% ahead of inflation, which doesn't support a high drawdown rate, which then increases with inflation. However, with living annuities, investors are able to invest in a range of asset classes, including stocks, including property, including offshore investments, which have historically been the most reliable asset class to deliver above inflation returns. When it comes to stocks, whether local or internationally, over the long term, have beat inflation by 7% a year, plus minus, on average. And so that is an option that's not really available to you in a guaranteed annuity, where you can't choose an underlying investment portfolio. You're not able to control your inflationary increase of your income necessarily throughout the year.
Yeah, I want to come a lot more to around assets, but Brett, if I can come to you on drawdowns, there is legal requirements in terms of minimum and maximum drawdowns, are there not?
That's correct. So the minimum is 2.5%, the maximum is 17.5%. Obviously, the lower the drawdown, the more sustainable the fund will be over time. As a general rule of thumb, we're looking at a 4 or 5% drawdown as a sustainable level. I think over 6%, you'll start to put a bit of pressure on the funds in terms of the long-term sustainability. So it is something to try and control if possible. Obviously, we understand that clients have needs and income requirements, but if you can control your drawdown to a sustainable level, it will certainly help in terms of the long-term sustainability of the fund. What I've also found with some clients is when they do go on retirement, they are able to take a tax-free portion. And if they do take that tax-free portion, it helps them with regards to the impact of the first few years of the drawdown. So if you have a lump sum, it has a bit of liquidity, you have a little bit of liquidity, and that puts less pressure on your first 2 years of drawdown, meaning you can take a lower drawdown, a more sustainable fund, and still have the liquidity to provide the income that you need for at least the first 2 years.
Okay, that is deeply cunning. I hadn't actually thought of that because, yeah, I mean, if my memory is correct, 2/3 has to buy you an annuity. The rest you can take cash. There is that tax-free component you can take as well, and that can give you, depending on your needs, as you say, a couple of years of buffer. Which, again, because we're at the age of 60 or 65, your life expectancy is quite potentially 30 years, and truthfully, that, as I say that, I've realized I've been saying that for a decade or two. It might be 40. I mean, 100 is no longer the scary, crazy number it used to be, particularly looking at the youngins of you two. Lots of us are going to get to that 100, and it does give you some flexibility. That drawdown, and I'm interested you said that it's 4 or 5, because I was going to ask the question, and it's popped up in the Q&A box. Is that 4% the magic number? Certainly, you're saying it is around there. What's important is that needs to include fees. And Kelin, you mentioned fees earlier. Brett, fees are we know, and I think 20 years ago, perhaps we didn't, but I think these days we are aware of the significant impact that fees can have. Example, if I'm drawing 4%, but my fee is 4%, well, actually, I'm drawing effectively 8%.
Correct. And it's something that an investor can control. As you mentioned earlier, inflation is out of our control, but fees are something we can control. It's very important to understand what your EAC is, which is your effective annual cost. And essentially, that's a summary of all the fees and charges that you will have in your investment. If you can find that out, it's great to know what your cost is. If you don't know, it's good to do a cost comparison. 10x does cost comparisons where we look at fees and returns. I think fees are one of the biggest destroyers in terms of wealth over time. A small fee, 1 or 2%, might not sound like a lot now, but you compound that over 20 or 30 years, a massive difference in what you get at the end of the day. So, yeah, very important fees.
I want to touch on that EAC, effective annual cost. And I've chatted with colleagues of yours before, and they always come back to it. As I understand, that is like a legal all-in definition. If I go to my provider and say I want the EAC, and they say we don't have one or something, my short answer is then find another provider, because that really is the crux number, and it is the true number, which reflects all cost.
Correct. It's a summary of all the fees that.
I think we've lost Brett suddenly. Kelin, you can still hear me.
So it encompasses everything.
Yeah. Sorry, we lost you for a moment there, Brett, but you are back. I want to touch on asset allocation, because when I speak to smart investors, and I spend a lot of time speaking to people around individual stocks, should we have, I don't know, CMH or we buy cars? Should we have Microsoft or Nvidia or the like? But my sense is that asset allocation, and folks will say to me, is perhaps the even more important question. Brett, getting that offshore local, that bond cash equity, getting that blend is perhaps the bigger challenge.
Correct. And I think a common mistake from retirees is they go too conservative too early. It's very important to make sure that you have the correct asset allocation, just so you can essentially grow your funds, beat inflation, and be diversified. We know with diversification, it helps with regards to the risk. So yeah, diversify your investments, make sure that they spread out, and invest in the correct asset allocation according to your time horizon. If it's a shorter time horizon, then yes, you maybe want to be in more defensive assets, bonds and cash, but certainly, as we mentioned, a living annuity time horizon is 20, 30, even 40 years. So you want to be exposed to the correct asset classes. And we've seen over time with history, equities outperform inflation, and that's really where you want to be invested.
Kelin, is there an argument, and a lot of folks will look at our stock market, I was going to say load shedding, which we haven't had for 2 months, touch lots of wood, and say, I want to be as much offshore as possible. 2 questions. Is there a limit to how much I can take offshore in a living annuity? And is there a downside to saying, take me offshore 100%, or as much as that limit is?
Sure. I mean, first, let's deal with the question of, are there limits? A living annuity is not governed by Regulation 28 of the Pension Funds Act. So you're not limited to 45% offshore. You can invest up to 100% offshore with a living annuity, and some investors do choose to. So why do investors want to invest offshore? Well, from our experience, the 2 most common reasons investors are seeking additional offshore exposure is 1, to access broader investment opportunities. So to access investments in some of the fastest growing countries in the world, in sectors and industries and companies that are titans of global industry that are not available in South Africa, to access certain sectors such as AI, for example, which there's very limited opportunity to access on the JSE. So definitely in terms of broader opportunities, investors appreciate that. The other is diversification. Investors are looking to diversify away from country-specific risks. And while it's not specifically limited to the investment portfolio in their living annuity, many investors also consider the rest of their assets that are not sitting in their post-retirement portfolio. So you might have, a house and a holiday house, and you might have, a business that's in South Africa. You might have the rest of your wealth in South Africa, and so they see this as an opportunity to diversify. And the other is investors who are actually spending more and more time out the country, where their income, their expenses are actually more and more in hard currencies than in rands. And so investors looking to match their assets and liabilities. So those are the reasons people like to invest offshore. But I think to your question, how much should you invest offshore? The answer is not 0, and the answer is not necessarily 100%. More often than not, the answer lies somewhere in between. So, the 2 things to consider with investing offshore is, first and foremost, matching your assets and liabilities. Are the bulk of your expenses in rands, or are they in dollars or pounds or euros, as the case may be? Are you spending most of your time in the country, or are you actually, split life living, visiting grandkids in Australia and the UK and wherever, or are you living offshore? Those are the kinds of factors, the more your expenses are in rands, the majority of your assets should still be investing in rand-based assets so that you don't have that income mismatch. And then the other really comes down to exchange rate fluctuations. The rand is one of the most volatile currencies in the world, and the exchange rate can either work for you if your offshore investments are doing positively and the rand depreciates, you get a double whammy and you get strong returns. If your offshore investments are performing strongly and the rand actually strengthens, it can offset those returns. And sometimes you have actually the double whammy to the downside, where offshore investments are performing poorly and the rand is in a position of strength, in which case you can magnify the losses. So when it comes to a living annuity where you're actually drawing down income from your portfolio, the volatility matters. And so you must be willing to be able to endure the fluctuations of the currency and the impact that has on your income. And particularly for investors who have a higher drawdown rate, you really want to be careful of taking on too much volatility in your investment. If there was a magic number, our research has shown that as you start diversifying offshore, you increase your probability of success, so you mitigate the probability of running out of money, and that really sort of gets to peak benefit of about 40% offshore. Between 40 and 60% offshore, that seems to be the range where it's adding the most diversification benefits to a RAND-based investor without compromising the success of the living annuity. Beyond that, for a RAND-based investor, the currency actually starts increasing the probability of running out of money.
Yeah, and I take the point. I was chatting with someone over the weekend, a currency trader, and he says, in the week post the elections, our rand could be 17.50, it could be 19. And as an investor, you don't want to get caught on the wrong side of that. You need to match expenses with the offshore. The question is coming through, Brett. I'm going to throw it to you because James is saying, if I start off with a riskier allocation, can I switch to a lower risky annuity later in the day? Truthfully, you don't need to switch, as I would understand. You can change the assets within, or do you need to switch?
100% correct. So you can change the underlying fund within the living annuity itself. So you can change from an aggressive fund to a conservative fund and back to an aggressive fund, depending on what you're looking to do. So there is flexibility in a living annuity, as we have discussed, of being able to take breaks from the market, get back into the market. Obviously, it's very important to still look at your long-term time horizon. I don't think anyone should be switching in and out of portfolios too often, but it is important to look at where we are in terms of the market cycle and understand what's coming ahead as well.
Yeah, I mean, this should almost be, because what you don't want is someone to be effectively trading within their annuity, because truthfully, most of us will lose money as a trader. But I suppose a review, maybe it's an annual review, maybe it's every 5 years or something. You started the process with certain things in mind. Life changes for all sorts of reasons, to sort of have that regular review to decide if that initial allocation still meets what you're trying to achieve and if it is meeting it.
100% correct. And as we say at 10X, is the time drives investment risk. So initially, when we set up a living annuity, we look at the time horizon and base the investment selection on the long-term time horizon, as opposed to the short-term market noise. It is easy to get distracted, but I think part of our job as consultants is to guide the clients and kind of redirect them to that long-term objective that they're trying to get to.
You almost, and I had the conversation with a financial advisor recently, and at the end of it, I said to them, they're almost like a therapist. I mean, I imagine oftentimes you're trying to talk people down from the ledge. They've got fear, they've got FOMO, and it's about reminding folks that this is a long-term process, and the things that we are terrified of today, we usually have completely forgotten about in a year, never mind 5 years.
Correct. It's all about managing emotions and understanding. Oh, sorry. Yeah, like I said, it's just about managing emotions and the benefits.
Yeah, it is. And unfortunately, money is a deeply emotional thing. Louisa is asking what the current life expectancy for South African male and females are. I don't know if either of you gentlemen know it.
Well, according to actuarial tables, most of the actuarial tables predict an age of 85 as the life expectancy. But that is completely subject to change. I think that's sort of the challenge, right, with guaranteed annuities, is that there's no one number. It's very much driven by your personal circumstance. So the insurer will understand your medical conditions or understand your specific life expectancy over and above sort of the income you're looking to draw.
Yeah, and it's that, and again, this is a 15-year-old number, so it's a bit out of date, but that a married couple at the age of when they turn 60, assuming they're the same age, 50% chance one of them would live to be 90, and statistically it would be the female. And that's, if anything, skewed out to longer, certainly not shorter at any point. Is there? I mean, Brett, one of the fears undoubtedly is about running out of money, and we've spoken around that, and part of that is where we can go get a guaranteed annuity, essentially an insurance product. But the living annuity, it needs to be, I suppose you sit down and you kind of think, well, what is that life expectancy going to be? And let's say we pick a number and you're currently 65 and you take the 85 expectation, you've got to almost err on the side of caution, I suppose, rather than say, well, it's 85, because of course, it might not be. And making sure that you have something left, because the last thing you want is in your final years to literally have run out. We can manage it, as I said, with the guaranteed, but again, it's that revisiting and recalibrating.
Correct, and it's all about controlling the controllables. Your drawdown, your fees, something you can control. Markets, inflation, unfortunately, out of our control. So if you can control the controllables, ensure that your drawdown is low, you have low fees, it does give you a chance of ensuring that those funds last beyond life expectancy, even where you can even hand them over to a beneficiary to inherit.
Question coming through from Marty around the EAC, and obviously we're talking living annuities. Guaranteed, Kelin, a guaranteed is not going to really have an EAC because it is just a life product, an insurance product. But do you have much flexibility to negotiate?
So when it comes to a guaranteed annuity, because it's not an investment product, it won't have an effective annual cost. That's a concept that applies to investment products. With a guaranteed annuity, the fees you pay are already reflected in the guaranteed income amount. If an insurer is charging you higher fees, they're taking a greater percentage of the upfront capital that you're handing over, and that will result in a lower fixed amount that's being paid out to you. So it doesn't show up as transparently as an effective annual cost for an investment or a living annuity would.
A great question coming through from Joanne. She's asking, does a living or even a guaranteed annuity need to be set up with monies from a Reg 28 vehicle, or could one use a lump sum from a discretionary account?
Yeah, so a living annuity has to be funded by a retirement fund. So that's a provident fund, pension fund, preservation fund, or retirement annuity. If the funds are in a bank account or in discretionary savings, unfortunately, they can't go straight into an alley.
Okay, but then a guaranteed, I imagine I could fund with almost anything. Again, I'm essentially buying a life insurance product. A question coming through from Richard. He's asking if you can switch between living annuities. If you don't like your current provider, you're with provider C, and you instead want to come to provider 10X, can you switch living annuities, Brett?
Most definitely. It's called a Section 50 transfer. And yeah, it's just a simple switch from one provider to another. What's important with regards to switching as well is there's no disruption in the income. So clients will continue to receive the income. Very important to know. You don't want to miss out on debit orders and a monthly income. So there's no disruption in your income. And if you are looking to switch across, we do, like I said, we do a cost comparison report to see if it's worth it or not. Feel free to reach out to the team to do that.
Are there fees? Because I remember switching a retirement annuity, and I must stress this was an old school retirement annuity. I'd taken out in 1994. The fees to switch were eye-watering, and they were being charged by the company I was leaving. Excuse me. When I say eye-watering, 28%. But then I ran the numbers on your website, and I was still going to come ahead just because their fees were so eye-watering that I was going to. But is there going to be a cost? Is there going to be a significant? I mean, obviously the Section 50, there's some paperwork and the like. Are there much fees involved?
Not from switching from living annuity to another living annuity. We generally see fees from older school retirement products, pre-retirement products, so retirement annuities generally.
Yeah, and here's a lesson, folks. Two things. When you're trying to move out of a retirement annuity, okay, a couple of things. If you've got an old school retirement annuity, it is almost certain benefit that you get out of it because the fees are they should be illegal. You can do the cost comparison, and the provider you're leaving will quote you a number that seems terrifying. Again, run the numbers. Invariably, it's not a problem. And thirdly, when they give you a quote as how much they're going to charge you, reject it, ask them to do it again. I did it 3 times until eventually I got to a fee which was single digit, but the first fee was almost 30%, which is, I think, is max by law. So like rattle that cage. Brett, back to you. Payment schedule. So my drawdown, which is 2.5 to 17.5%, is it annual? I mean, how often can I tap in?
Yeah, so the client has the choice. They can decide if they want the income monthly, biannually, quarterly, or annually. You can change your income frequency once per year as well. So on your policy anniversary, you are able to update it. So if you want to change from monthly to annually, you can do so. So there's a little bit more flexibility as well.
Okay, and then a question coming in: what happens if I'm doing my 2.5% drawdown, which is the minimum required, and it is simply too much money? Look, firstly, you've got a great problem. Don't get me wrong, but secondly, you can take that excess and reinvest it. Kelin, I could even take that excess and stick it into a Reg 28 fund to help my tax liability.
Absolutely. I mean, that sounds like an excellent problem to have if you're drawing down the
Yeah,
minimum and it's still too much money. Yeah, we have seen many clients actually in this position, and what we've seen some clients do, because the income you draw out of your living annuity is taxable. If investors are find they don't actually need all that money, we see them add it to a retirement annuity, and because their contribution to the retirement annuity reduce their taxable income, they actually offset any of the excess income that they needed and shield some of that from tax. And at any point, because in that case the investor would be post the retirement age, the investor would always have the option to flip that retirement annuity into a living annuity, and in fact it can go into the very same living annuity. They don't even need to open up additional policies or anything like that. And you can, if you wanted, you can align your investment portfolios between the two. So yeah, it is something we see clients taking advantage of.
Yeah, I met someone in Cape Town a couple of years ago. I think actually it was pre-pandemic, so it was now 4 years ago. And that's what he was doing. He didn't need as much as he. I had wanted to stay away from tax, but I think a quick tax question is important. The money I get out of a living annuity, is that taxed as income?
Yes. So
Okay.
regardless of which annuity you choose, whether you go with an insurer and get a guaranteed annuity, or whether you choose an investment company and have a living annuity, your income that you take will be taxed as income, and you'll pay as you earn tax on that. I will just say on the point of tax, when it comes to a living annuity, while the income you're taking out of a living annuity is going to be taxed as income, all the growth in your investment returns are tax-free, which is a massive benefit as you get to compound your growth and make your income more sustainable by shielding that growth from tax. And then we've touched on earlier as well, any capital that's left in your living annuity bypass your estate, so very favorable in terms of estate duty tax.
Gotcha. And that was probably why the earlier question was, can you open one with discretionary money? Because that is quite a nice little benefit there. Sandesh is saying, is there an optimal mix between guaranteed and living? We spoke about this, Kelin, up front, around perhaps doing a bit of a blend of each. I'm going to suspect this is going to be individual dependent, perhaps.
Yeah, so it's completely individual dependent. Ultimately, what you are deciding is how much income you really need to sustain yourself, and whether or not, if you handed over all your capital to an insurer, the amount of income would be more than you needed, and whether or not you wanted to leave any money to your kids, your family, the charity, anyone you really wish to bequeath money to. So that's really kind of the distinction. The good news is, as Brett alluded to earlier, you absolutely can split out your money from pre-retirement source. You can put a portion in a guaranteed annuity. You can use that just to secure like a minimum level of income. Like you said, could be your medical aid, could be your grocery bill, as the case may be, and the rest can go into a living annuity. Why we see some investors doing that is because it eliminates some of the anxiety around running out of money, because they know like this minimum core set of expenses is covered, while at the same time retaining all the flexibility, all the benefits, all the tax benefits and the legacy benefits of a living annuity. So even when we do see investors split, we still see the bulk of that money going into a living annuity.
Louise, you have a tax question, so I'm going to half answer. But you make a great point. You say minimum personal income tax is 18%. Regarding the lump sum, you get the 550, no problem. The next tranche is taxed at 18%. Should you not then also take that? I'm not going to give you tax advice, but I'm going to say that Kelin made a great point a moment ago that the growth within the living annuity is tax-free. And that is powerful, particularly if you consider that this is a 10, 20, 30, 40-year investment. That suddenly becomes absolutely important. Amanda, we had answered that one. explain the logic of annually flipping between a retirement annuity and a living. So CS, just to go back to the point, we're not flipping between, but the income that you get out, you can then put into a Regulation 28 product that reduces your tax burden in the year. Of course, when it comes out the other side, there are going to be limits in terms of what you can do with it. We know all of that, but it can, in the short term, particularly perhaps when you're taking more help in that regard. Brett, I want to come to you. We've touched on inflation. We touched on the fact that in a guaranteed product, inflation is your biggest risk, just because we don't know what. There'll be years when inflation is low, but there'll be years when it's high, and you need to manage that. In terms of the living annuity, you don't. I mean, you're not completely. You can't remove the inflation risk, but you've got that flexibility that if you've discovered that things are more expensive this year, you could up from 4 to 5% drawdown. Of course, you've got to be careful because you're already at 7. You don't want to be pushing to 8 or 9.
Quite right. Quite right. And you can change your drawdown on an annual basis as well. So it's always good to chat to a professional, someone you deal with, do those reviews, look at your expenses for the year coming up, look at what you've received over the last year, and really decide if you need to increase or decrease your drawdown. Inflation will always be there, fees will always be there. But like I said earlier, you can control your drawdown and especially your costs as well. So yeah, it does make sense to do that.
Question from Alan. He's saying, what sort of fee should, we've been talking about fees. We've been saying, be careful about fees. We've been saying that too high a fee can really damage things. He's saying, what is a fair fee? To which I suppose I'm going to say, what is a 10x fee?
Yeah, so it depends on the asset value. The fee start at 0.86% and then drop down as your asset value increases.
And that is an EAC, so that is everything.
That is just a management fee. It
Okay.
depends on the underlying fund where we will get the total EAC.
Okay, gotcha. Okay, but that is, my favorite fee always starts with a 0. My absolute favorite fee ends in a 0 too, but that doesn't happen. Okay, we've answered that one, folks. I'm going through your questions. If you've got, absolutely send them through. Ella, you're asking, is it possible to move from a provident fund at resignation with my current employee to a living annuity? My understanding here is you need to be 55 years old. Question coming, is there an upside age limit? There isn't. There used to be, if I recall correctly, way back, I think it was 69, but I think that's fallen away. And now you could literally, as a 90-year-old, take out a Reg 28 or come into an annuity.
Absolutely, there are no age limits. You can start a living annuity at any age. Obviously, for an individual, it's literally, do you need the income or not? If you don't yet need the income, then we do see some investors actually defer their retirement to a later stage. The money sits untouched in their retirement funds and continues growing. And when they're ready, they then come to us looking for a living annuity to start earning income. So completely possible at any age.
I remember somebody, and again, this was a while ago, they actually delayed their retirement by a bit and essentially lived off some debt for a year or two. And I can't remember why he was delaying it, but they just lived frugal. They lived beans and tap water for a couple of years. He says it was tough, but it gave them a better retirement, and they were prepared to take that short period of pain. Mervin's asking a threshold under which will be best to go with life/guaranteed rather than living. I'm imagining, Brett, that this is more, it's going to be situation specific. And this is something which you need to run those numbers. We can't say this is the magic number above or below. It's going to be, we need to know what your needs are and what your capital is.
Quite right. There's no one solution for everyone. It does depend on the personal circumstances.
Great question from Joanna. I hadn't thought of this. If you've got a guaranteed annuity, it can be for you and spouse, and it can terminate on the passing of the second, so that guaranteed. And there's some T's and C's in those cases. Joanne's asking if a living annuity can go into the estate. Can I pass on the benefit of that and the whole the actual living annuity to my spouse, or would it be in both our names? I'd never thought of this.
Yeah, so that's fairly straightforward. So First of all, if there's any capital left in your living annuity, it doesn't form part of your estate. So there's no estate duty. Your living annuity is going to the nominated beneficiaries who you've put down. So you can literally decide who the benefit of your remaining capital goes to. Your beneficiaries have effectively two options available to them, or three. The first option is they can take out the remaining capital as a cash lump sum, and there will be some tax on that. However, if the surviving beneficiaries would like to still continue drawing an income, they are more than welcome to annuitize the capital. So they would take the capital from the living annuity and they could purchase a living annuity of their own. And the same principles will apply, choosing their portfolio, choosing the amount of income they need, making sure their fees are low and that's sustainable. Or if the surviving beneficiaries would like to rather take that money and go into a guaranteed annuity or with profit annuity, that is also an option. So they can take cash as a lump sum, or they can annuitize and continue drawing an income.
Cool, great. A nice question here from Daniel. He says, I currently have a 10x Reg 28. I also have discretionary in funds invested. Is it possible to donate the discretionary funds into the Reg 28? My understanding it is there are limits, 27.5% and 350,000, but those limits are for the tax benefit. I can exceed those limits. Yeah. So Daniel, you can. Sure. And here's another fun fact. Kelin, maybe you can help on this, or Brett. If I exceed the limit, I don't lose the limit. I can roll it into future tax years.
Yeah, correct. It just rolls into the following year.
Yeah, or the follow, whatever, as the case may be. Vincent's asking, how do you insure against risk of longevity? And I take the irony of risk of longevity, but I think he's 100% right. Change from aggressive to moderate does not necessarily protect against that. I mean, it's a good point. And my sense is that we almost manage the risk of longevity by saving more, but there's another trick to it. And I remember running the numbers on this once. And in fact, it might have been, I did it with one of your colleagues at 10x Investments, where delaying retirement by 5 years. I mean, if I remember correctly, a 10-year delay in retirement could double your money into retirement because A, you had an extra 10 years of saving into the fund. B, you had an extra 10 years of growth. And C, you had a less 10 years in retirement, so less worries about longevity. Is delaying retirement that powerful if you get to the point and you think, I simply haven't quite got enough?
Yes, Simon. So delaying retirement is absolutely possible. And why some investors retirement is because, one, they don't yet need the income. They potentially still have enough discretionary savings and investments to live off of, or they're still earning an income, either full-time or part-time. And so what that effectively means is their money gets extra time to allow the benefits of compounding to do its magic. And there you start off with a bigger pot of capital at retirement, which can sustain you for longer. But to go back to the question of longevity risk, how do you make sure you don't outlive your capital? It is painfully simple. As long as you only live off the returns and don't touch the capital, you will never run out of money. So the very simple formula is your returns should equal the inflation, your drawdown, and your fees. So if you're getting 10% returns, inflation's 5%, your drawdown is 4%, and your fees are 2%, well, actually, you're drawing down 11% when your returns are only 10%, which means you now are starting to take some of the capital. You're not just benefiting from the returns. Very easy way to fix that. One would be lowering your investment fees. So changing to a living annuity provider can drop your fees down to, say, 1%. All of a sudden, you're now only living off the returns. Or you could adjust your drawdown rate, say, from 5 to 4 or 4 to 3, and bring that equation back into balance. This is how wealthy people have lived for generations and passed on generational wealth. They live off the returns of the investments, never touch the capital, and you have zero chance of running out of money so long as you keep those two sides of the equation intact.
I Never thought of that. You've kind of boggled my brain. There is a perfect 100% zero chance. I take the point. And some years your returns mean you're drinking box wine, not fancy Bordeaux wine in Bordeaux. Sibongeli, you're asking a question, and the answer is simple. Is it advised to start one's financial planning journey at the age of 23? I mean, Brett, the answer is yes. I mean, yes, and congrats for at the age of 23 being on a retirement webinar.
Yeah, 100% correct. The earlier you start, the better. As we know, compound interest is our friend. Speaking to a lot of younger investors, what kind of seeing the investments grow throughout time, they're really glad they started early. So yeah, definitely get started as early as you can, and look at the range of different investments that you can invest in as well.
Yeah. And at the age of 23, don't worry about being low risk, because what you have on your hands is just time in a. You've got like maybe 80 years of living. Rook's asking a great question. Is it possible to partially switch from a living to a guaranteed? And I think the answer is no. Kelin, we were saying up front, that's why to structure it cleverly and maybe have a couple of living annuities, maybe instead of just putting it all into one, put it into 2 or 3. They might be identical, but then you could switch a part into a guaranteed.
So it is possible, but not directly from, you can't just switch a part of one living annuity to a guaranteed annuity, but it is possible to split a living annuity. So an investor might have one living annuity, they could split that into 2 or 3 living annuities, and from that point, they could transfer one of the living annuities. But the first step would have to be to split up your investments. But if you're just transferring from one annuity to another, then unfortunately it has to be all or nothing.
Gotcha. Okay, no, I hadn't known that either. Louise is asking a great question. My current RA, can I choose to, say, use 50% for a living annuity and leave the remaining 50% in my Reg 28 product? In other words, can I cash out half the Reg 28 and say, keep the rest for now?
Unfortunately not. When you retire from a fund, you have to retire from the entire fund, meaning you can take out a third, but the remaining 2/3 will have to be annuitized.
Yeah, I thought so. Rakesh says, can I purchase a living annuity for my wife with my RA at maturity? Brett, does it have to be my RA, my living annuity?
Yep, it has to be in your name, your living annuity.
Yeah, sorry, folks, we're running into the laws here. Ain't nothing we can do about the laws whatsoever. Vincent, I think, is going to have a great question. Vincent, you're saying the role of an advisor is important. A lot of the options you are talking about require the advice. Are the advice fees ongoing? It's a good question. You mentioned, Brett, from 0.86% down. Is that including my ability to phone you on a regular basis and say, Brett, please help?
Correct, yeah. So as Tenix consultants, we love assisting clients. We help invest direct, and we're just here to kind of hold their hand through the process. So yeah, there is someone at the end of the line that can speak to. Pop us an email, give us a ring. Always happy to help.
Okay. Folks, a lot of questions coming around that splitting. Kelin had the solution there. You break it into pieces, and then you can transfer some into a guaranteed. You can, of course, at the beginning also put some into that guaranteed. Deirdre is saying 57 years old, have a Reg 28. Is it better to keep in the Reg 28 or in a living annuity? My sense, Kelin, the growth would be potentially the same. They could be invested in the same funds. The distinction is the living annuity, you're going to have to take at least 2.5%, which you might not need. So maybe staying in Reg 28, if you're still working, is the easier answer.
Absolutely. The only question is, do you need an income from your savings or not? If you don't need an income, then remain in your pre-retirement product. You can continue contributing to it. You can continue letting the investment growth work in your favor. You don't want to be drawing down from investments if you don't need to, rather put it to work.
A couple of people are asking this question. Kelin, I know you did answer it, but let's go to it again. On the passing of both spouses, does death duties, does it go into the estate? Does it go straight to the heirs?
So this is the big benefit of a living annuity. It really does fit well over and above the flexibility and the control and all the tax benefits. The big benefit as well, which you absolutely cannot get in a insurance type guaranteed annuity, is the legacy benefits. So when you pass away, whatever capital is left in your living annuity can go to whoever you nominate. If it's a spouse, then your spouse can take out a living annuity with the proceeds and continue earning an income. Should your spouse pass away, if there's still capital left in your spouse's living annuity, that capital can be passed on to whoever the spouse nominates. It can be a child, it can be a family friend, it can be a charity, for argument's sake. So long as there's capital remaining, it can be passed on. Unlike a guaranteed annuity, which might come with a joint life benefit, which means you're going to get paid an income until the death of the last spouse, a living annuity, so long as your capital remains, can effectively be passed on for generations.
David's got a great question. He says, I'm 70 years old. Last year, I took out a Reg 28. Brett, can he now transfer that into a living annuity tomorrow? There's no duration required from a Reg 28.
No, he can retire from that tomorrow and convert that to a living annuity at any stage.
Yeah, gotcha. Folks, I'm going through a lot of the questions we have answered, and we are starting to come up against time. As I say, Alan is saying the 0.86 that you mentioned, the fund on top, what sort of fund costs are? Because of course that's something that the investor is going to have to incur as well. And I appreciate they're different funds, they're different fees, but do we sense a ballpark around a fund fee, Brett?
I think Kelin has a bit more information on that actually.
Sure, I think it is all going to depend on what portfolio the investor selects. So some of our most popular funds, which contain a high exposure to equities and properties and have defensive assets like bonds and cash, so a well-diversified, balanced portfolio. You typically, when you add in together your living annuity fees and everything, you come up to a fee of less than 1%. So this is for everything. If you just looked at the transaction costs and underlying costs in the investment portfolio, it's about 0.15%. On our most popular fund. For investors to choose different portfolios, so for example, investors looking for more offshore exposure, those can come with additional fees, but the investor can request an EAC quote, which shows your all-in effective annual cost, showing the cost of your living annuity, your investment portfolio, and your full fee that you pay at the end of the day.
Mervin's asking a great question. Can I invest into a hedge fund via a living annuity?
I am not 100% sure on that.
Brett, can I invest into a hedge fund?
At 10x, we don't offer hedge funds.
No,
so I'm not entirely sure if other providers do it. It would have to be provider dependent, but from a regulatory perspective, there shouldn't necessarily be any obstruction from investing in a retail hedge fund.
Arthur, you're asking if Kelin works for 10x. Yes, he's not independent. He is with 10x. He's asking if there is an advice fee to get information from you. In other words, and as I understand, I mean, Brett, that's more your scope. Again, that's part of the EAC effectively. I mean, you're not going to hit them with an invoice at the end of the conversation.
Correct. That's part of the fee, and I think from our side, it's all about educating clients as much as we can. I think the more informed they are, the better decisions they make. So it's not us making decisions for them, it's educating them so that they can make the right decisions at the end of the day. And that's just part and parcel of what we do.
Louise, you're asking if there's a website where you can see different performances within the state. Is there? I mean, can you, because of course, you folks would manage it, but you'd put different funds in it. I suppose you could then give a sense of what historic performance has been, with the always asterisks of past performance is no guaranteed of future.
Yes, I mean, past performance does not guarantee future performance, as you know. If you look at our flagship balanced portfolio, that portfolio is delivered over 15% a year, compounded for 15 years. So what does that mean? It means if you're generating 15% a year, you're effectively going to double your money just under every 5 years. So those are stellar returns, some of the best in the industry. And it also depends on the time horizon. So for example, the last decade has been really favorable for offshore and US equities. So our international portfolios have delivered returns, some exceeding that. But again, past performance does not guarantee future performance, and investors should pay careful attention to having the right asset allocation and the right onshore and offshore exposure for their time horizon and their investment objectives.
But you're asking the drawdown, is it based on the initial fund value or the current? It will be based on the current. Charmaine, you're saying if I defer my pension, who does it stay with? Well, it would stay with wherever that pension is at this point in time. You could move it into a preservation or the like, but it would still potentially be invested at its original place, or if you wanted to move it, if you thought there was a better option. Peter's asking, moving overseas. Yes, if I have retired and I have myself a living annuity, Brett, and then I discover that I'm heading off to, I don't know, live in Guatemala or somewhere, can I cash it out? Can I, as I would understand, it would still exist, it would still pay out in ZAR, and I would have to convert those rands to wherever I was.
Yeah, so you can't cash it out all as one lump sum, but what you can do is increase the drawdown to the maximum, get that income paid to your South African bank account, and then send it overseas. It is what some clients do at 10x, just to ensure that they get the capital out as quickly as possible.
This is a great question. JP says, retired 4 years ago, took out the 500,000 tax-free, put the rest into an annuity, and you go claim the extra 50,000, because I think it was last year's budget when the finance minister moved the 500 to 550, and he claimed the extra 50, or is it a case of you retired 2 years too early?
Unfortunately, investors would be subject to the prevailing regulations at the time. And so, unfortunately, 4 years ago, the tax-free lump sum withdrawal from a retirement benefit was 500,000. Unfortunately, there's no lucky packet this year.
Yeah, no, there isn't, and unfortunately, when you do the process, whatever the laws are at that point in time are the applicable laws. Henk, you're saying, can you split? If it's my Reg 28, could I get 2 living annuities, one for me and one for my spouse, Brett?
You can get 2 living annuities, but they'll have to be in his name or in your name. It won't be able to set one up for your spouse. They'll have to be both in his name.
Yeah, gotcha. Folks, questions coming through. We have covered them. We'll leave that there. So then, and we have also hit our time. Kelin, Pottier from Solution Strategist at 10x, Brett Mackay, investment consultant at 10x. Appreciate both of your times. Just a final concluding question from myself for each of you. Kelin, I think the 2 key points that we made, and one of them was right up front, which was sort of give thought to a blend of living and guaranteed. And maybe you don't need the guaranteed, but I think it's a conversation that perhaps is worth happening. And perhaps more importantly, as much as 100% offshore might intuitively seem attractive, rand strength can hurt, and you need to match your income with your expenses in terms of currency to a degree.
Yeah, completely agree. For those investors who are on the fence, there's many good resources out there where you can read up on the benefits and drawbacks of each of the options. Equip yourself with the right information. If you're at the point of retirement and you need to make a decision and you still aren't quite sure, a living annuity is always a great choice, because that's a completely reversible decision. If you decide you want to actually be in a guaranteed annuity because it makes more sense, then you can do that. But if you go straight into a guaranteed annuity, that's one and done. It's irreversible, and that's where you're stuck. So if any investors are on the fence, rather take your time, do your research, and if you must make a decision, try and give yourself some options.
Yeah, that's a good point. The guaranteed annuity is not reversible. That perhaps is the key point. Brett, for you, and I started this by saying that we hit retirement and we have the biggest questions of our life, which is now we've got a giant pool of money. What do we do with it? In essence, the port of call is to give 10x a ring and chat to folks like you, because there are a lot of options. And truthfully, you're one of the experts out there who can help us through. I don't want to say it's a minefield, but it's certainly a lot of complicated and hugely important questions that we have.
Correct. I think it's important for retirees to remember that they're not alone in this journey. There are professionals that can help them, guide them through, whether it comes to choosing the appropriate drawdown, looking at the fees, even in the asset allocation. Those are all really important factors that someone needs to consider with their living annuity. And not every person on the street understands exactly how to do that correctly. So yeah, we're here if they need any help.
Yeah, I like that. You're not alone. Speak to professionals. There's nothing wrong with speaking to 2 or 3 and finding one who you like. And always ask about that EAC. Ladies and gents, we'll leave that there. We are seconds away from the full hour. Gentlemen, really appreciate your time today. I learned a bunch, which is really great. I hope that everyone on the webcast learned a bunch as well. We appreciate everyone who attended today. You had anything you could have done with your hour. You decided to sit with us and get a little bit smarter about your retirement. We appreciate that. Everyone, look after yourself, stay well, and as always, if you can, look after somebody else as well. Cheers all. Thank you.